Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending May 2nd, 2025. So the title of the review this week is Shades of Optimism. So we're seeing the stock market rebound. We're about, 12 to 15% from the post-liberation day lows. We're still about 8% from the highs that we've met on February 19. The stock market has rebounded quite a bit. The sentiment has shifted. There is some optimism for potential deals with trading partners. We're looking at Japan right now, which is negotiating with the US. We're hearing that Europe is willing to make some propositions, but they would want all tariffs to disappear. Let's see how Trump reacts to that. And also China, which seems to be open to negotiating, but when you read between the lines, you hear that China's position is that, well, show respect and remove all tariffs and then we'll talk. And then when you listen to Donald Trump, he says, well, they need to come to us and talk, and tariffs won't be removed altogether, but we can make some concessions on tariffs. So yes, there seems to be some willingness or some openness, let's say, to talks, but it doesn't look like we're getting close to anything imminent here. But the market is seeing things getting better, so it's always trading on how things are getting better versus worse. It's not about exactly where we could end up here, but if things are getting better, you're seeing things like this in the market report for the week. Strong returns, S&P 500 up 2% on the week, Nasdaq up 3%. Year to date, we're at -4 for the S&P, -8 for Nasdaq. Positive territory year to date for the TSX, for EFI, and for emerging markets. So it as though nothing has happened since the beginning of the year. Bonds were doing well. Commodities are not doing so well, so oil is trading like we're going to have some issues on the macro side, -17% year to date. Copper has depreciated as well. The price of gold, now we're seeing some profit taking there after a very solid streak. Now it should be the second consecutive week where we have a pullback in gold. It's been a while since we haven't had that. Canadian dollar pretty much stable on the week, but as I'm recording this on Friday morning prior to market open, we're looking at strength in the CAD, weakness in the USD, so we could have a different picture here. The trend of the USD is going down, continues to be an important theme here in the market, even though there's been a short-term turnaround here over the last week or so on the USD. So very complicated markets, lots of things going on, and that brings me to the latest monthly that we write. So if you want to have a better understanding, or do a deep dive into our thinking, I always recommend that you read our monthly macro and strategy. We published the latest issue yesterday on Thursday. So the title is The Tariff Men Comet. Because that's the aftermath of the Liberation Day. We're also looking at what Canada can do to address the vulnerabilities that were made pretty evident since the beginning of the year. We're also talking about, should we as investors change our long-term views or expectations on US assets? Is there permanent damage has been done here? As the US, change the perception of its how it can be trusted as a trade partner. So all of these questions, I think, are valid questions. So we're digging into them. If you want to have a reading that, I mean, we're pretty proud of this one. I mean, there was a lot of material to cover this month, which was a fun one to write. So I hope it's a fun one to read as well for you guys. So you have the address at the bottom of the screen here. Now back to the data. So mostly macro this week, and starting here, maybe tongue-in-cheek here, is this Biden's economy or Trump's economy? Because as you know, if you follow the news, when the GDP figures came out in the US showing -0.3% on the quarter, so a negative print, Trump said, well, this is Biden's economy, it's not my economy. So who cares whose economy it is? It is the US economy. But here, the question is, are we starting to see some effects of Trump's policies on the macro data? And the answer is yes. -0.3% on the left, but when you look on the right, final sales to private domestic purchasers. So this is really the gauge of the domestic economy. So mostly consumption and investment. Chart on the right, you see that the US economy is still doing just fine, but it's continuing the trend that we were seeing under Biden. So, that's the part where, is it really Trump's economy or Biden's economy? Biden's economy was doing pretty well as well. So minus 0.3. So what's going on? It's mostly imports that have risen because the idea is that businesses are front loading their imports before the tariffs kicked in. So this is what happened. So this is national accounting. It's technical, but when you import, this is a negative for GDP, because let's say you import $1,000 and you sell it to the consumer, consumes $1,000. It's a net zero because gross domestic product, the P, of GDP production, is zero because you imported the stuff that you sold. So this is how it's computed. So if you look at the next chart here, on the left you have exports versus imports. On the top left, you see that imports have jumped massively over the beginning of the year. Imports have contracted a little bit when you look at the year-over-year figure, but the trade balance, which is at the bottom, this is what Donald Trump is focusing on. Remember that the US economy is by design has a trade deficit on goods because it's an exporter of services and it consumes lots of services. So this is how it's built. So of course it's going to be negative, but look at how the trade balance just became much more negative. That means that imports outgrew exports in the first quarter. And of course, when you have that, you're going to have a hit on GDP. Now, some of those imports are going straight to inventory. So this is a positive for national accounting. So again, I hope I'm making this clear. National accounting is gross domestic product was being produced domestically. When you import and you sell right away, it's a wash. If you and imports are subtracted to GDP, so consumption grows, imports are negative, and net is zero. But if you import and you send that to inventories, inventories are a positive in GDP, and when you draw off of inventories, it becomes a negative for GDP. Again, just wanted to make to explain how these things work. But the game now is in imports and in inventories. Inventories have risen a little bit to what you see on the right, a little bit. Well, still a good chunk of growth was inventories, but it didn't cancel completely the rise in imports. So very likely in Q2, firms will be reporting their imports as a rise in inventory. So likely it's just a reporting issue and a timing issue here. So Q2 should be looking pretty good in terms of GDP because of the growth in inventories. And after that, Q3 and Q4, we should have a better picture of the US economy. And that's when we should have a slowdown that should be manifest if things stay the same in terms of trade policy here. So trying to make these things pretty clear, but the first quarter GDP was negative because there was lots of imports and not that much growth in inventories. Maybe this growth in inventories has been pushed into Q2, so that will make Q2 look good. And then after that, as we draw from those inventories and the uncertainty remains, this is the data that we have now, then we should have weak growth for Q3 and Q4. Now looking ahead, we had consumer confidence from the conference board this week. On the left, the blue line, this is the one that we got pulled back. The conference board index is very tightly linked to the labor market. It's following the pattern, although at a very much higher level versus the University of Michigan one, which is on the bottom of the left-hand chart, which is more sensitive to household finances. So what you're seeing is that based on household finances, the households are as pessimistic as they've been through history, the short history that we have there, just like in deep recessions or inflationary bouts. For the labor market, you're seeing the cracks appear, and on the right, the labor differential. So they ask the question, are jobs plentiful or are they hard to get? And if you do the differential between the two, you get the blue line, which is very correlated with the unemployment rate, which is the gray line, but the axis is inverted just so that they are pointing in the same direction, and they're pointing at more challenges, let's say, for the labor market. So The labor market for April was pretty good. We had the report this morning, but we should expect cracks to start to appear in May and June based on the timing of how things are unfolding here. So for Canada, just to conclude here, a seesaw start to the year. First 2 months of the year were pretty good. The latest report was it's December and January rather that were pretty good. February was a negative. We're starting to see some less investment from businesses. We're starting to see less hiring. So if there's always some volatility in month over month GDP in Canada, but we've had a bit of a pullback here. As we look forward towards the rest of the year, we should be expecting slow to almost no growth. It depends on what happens with the U.S. economy and with the tariffs for sure. But when you look forward, the Bank of Canada considered cutting interest rates in April. They stayed put. It's 2 months two decisions in a row that they did one thing but strongly considered the alternative. And now there was some debate already. The Canadian economy is still weak. Maybe it's a good time to continue cutting, but at the same time, we want to make sure that have more clarity. Want to make sure that we better measure the impact of all of those cuts that have been done already. So, they decided not to cut, but at the next decision in June, wouldn't be surprised to see another cut. And we still think that we'll be close to 2% by the end of the year on the leading rate. Right now, we're at 2.75, so that would mean probably 3 more cuts. What we'll be watching next week in Canada, we'll have the S&P Global Services and Composite PMIs. We'll have the jobs report as well. In the US, we'll have the ISM Services APMI index and the Fed decision. So the market is expecting the Fed to stay put. Almost no odds on a cut. We also think that they could not cut before because of the inflationary pressures that seem to be just around the corner. The U.S. economy is still doing good, but of course there will be some political pressure. We should expect Donald Trump to tweet and to start insulting Powell again. So could that lead to volatility next week? Well, probably. So we'll see how things unfold there. So another busy week in the books, another busy one ahead of us. It's always a pleasure to serve you. If you enjoy the content here, please share and of course come back again next week.